Buying your very first rental property is not only a great investment, it's also a badge of honor that very few people can wear. So in this video, I'm going to show you how you could buy and fund your very first cash flowing rental property as a complete beginner. And by the end of this video, you'll know more than 99% of beginner real estate investors, which will give you the confidence that you'll need in order to pull the trigger and make one of the most expensive purchases of your life. But before we go into the steps of buying your very first rental property, here is a scary stat that almost no one is talking about. According to an article published last year on PR Newswire, nearly all residential real estate investors, 90%, have lost money on an investment, with nearly half, 42%, reporting losing more money than they've made in real estate investing. Now, with the housing market closing in on $50 trillion in value, a real estate investor's $100,000 loss is a micro drop in the bucket. So in an attempt to help you avoid losing money on your very first deal, here is a simple step-by-step guide that will help navigate you through the murky waters of finding and funding your very first cash flowing property. Let's jump right in. Okay, so step number one is going to be picking a strategy. To simply put it, a strategy is how you plan on making money in real estate. Here is a list of the most common strategies used by real estate investors. Number one, short-term rental. Number two, midterm rental. And number three, long-term rental. And then from here, you're going to have subcategories like Airbnb and VRBO, which are going to be subcategories of short-term rentals. Now, Airbnb and VRBOs are going to be listing platforms that you could list your rental on. However, for the sake of this video, we're going to categorize Airbnbs and VRBOs as a subcategory of short-term rentals. Now, renting out an entire home or a private room within a home for 1 to 2 weeks or by the month is considered a midterm rental. Think of midterm rentals as short-term residency. Let's just say if you're a traveling doctor or nurse and you want to rent out a home for the entire month of January. Or maybe you're someone who is in transition to a new home and your new home won't be ready for another 3 weeks. And respectfully, you don't want to stay with friends or family. So you find a place on SplitPad, which is a platform that will allow you to rent out a home by the week or even by the month. This would be an example of a midterm rental strategy. But the most common strategy amongst real estate investors is going to be long-term rentals. Cash tenants and Section 8 tenants make up the vast majority of long-term rentals across the United States of America. So when you hear quotes like 90% of real estate investors become so through owning real estate, this is a quote specifically referencing a buy and hold strategy involving long-term rentals. Now, as you evaluate which strategy is going to be best for you, this is also where you get to determine how involved you want to be as a real estate investor. For example, if you wanted to purchase a short-term rental and list it on Airbnb, the average stay per guest is going to be 2 to 7 days, which means that there's going to be a lot of turnover. So you yourself or the individual that you decide to hire will need to clean and prepare the unit for the next guest every 2 to 7 days. Very similar to a hotel, this strategy will naturally take up more of your time. Versus if you chose a long-term rental strategy, most of the hard work is going to be done up front. And then after you find a tenant and lock in a 12-month lease, then you'll receive passive income every single month until the tenant decides to move out. Now, each strategy has its pros and cons, which I will not be going over in this video. However, if you want to know the pros and cons for each strategy, do me a favor and comment the phrase pros and cons in the comment section below, and then I'll make a separate video that outlines the pros and cons for each strategy, short-term, midterm, and long-term rental when it comes to real estate investing. But just to be clear, and for the sake of this video, I recommend for you as a beginner real estate investor, start with a long-term buy and hold strategy, because this will allow you to better understand the murky waters of real estate investing with a higher probability of earning a profit every single month or bare minimum break even, which will allow you to cover your debt. And you'll be able to receive tax benefits on passive income. Plus, you'll be directly contributing to housing a family in need of a home. So for the remainder of this video, I will be using examples with a long-term strategy in mind. Now that you have identified which strategy you want to focus on, step number two becomes a little easier. Step number two, pick a city, also known as picking a market. I will be using the terms city and market interchangeably, so just know for the sake of this video, they mean the same thing. Now, picking a city and market comes down to running the numbers. Here are a few questions that you're going to want to ask yourself before selecting an individual market. What cities are you going to cash flow in? What cities and states are landlord friendly? What city and market are you comfortable purchasing a home in that you don't mind visiting once in a while? And what city or neighborhood has the highest potential chance of appreciation? Now, since picking a city and market comes down to running the numbers, let's talk about the numbers real quick. The minimum monthly expenses that you will see when investing into real estate are going to be principal, interest, taxes, homeowners insurance, plus property management fees. And on the purchase side, you're going to have your down payment, escrow fees, title fees, inspection fees, appraisal fees, notary fees, attorney fees, closing fees, and a whole list of other fees that we're going to categorize as closing costs. Now, your success in real estate investing is going to come down to the numbers. So fully understanding your monthly debt, as well as recurring costs and operational costs and acquisition costs, is going to be crucial to your success. And since understanding the numbers are so critical and so important, here is a simple formula. Matter of fact, the only formula that you should know and master as a beginner real estate investor. Cash on cash return on investment. Cash on cash return on investment, which is going to be your net operating income or profit divided by your total out-of-pocket costs, equals your cash on cash return on investment. As an example, let's just say if your projected net income is $6,000 and your projected out-of-pocket cost is going to be $25,000. $6,000 divided by $25,000 equals 24%. 24% is going to be your projected cash on cash return on investment. This formula and the number generated from this formula is going to be everything as a beginner real estate investor. The higher the percentage number, the better the investment. The lower the percentage number, the worse the investment. Here is what's considered bad, good, and great investment, or cash on cash return on investment. A negative or a loss is considered a bad cash on cash return on investment. 0% to 7% is considered a good cash on cash return on investment. Anywhere from 8% to 20% is considered a great cash on cash return on investment. 20% or higher is considered pro status, and an infinite return is considered legendary. Now you may be asking, is an infinite return even possible in real estate investing? And the simple answer is yes. Here's an example. Let's just say if you bought a house for $50,000 and you added $25,000 worth of renovations into that house. Your total investment into this individual property is going to be $75,000, but let's just go ahead and add in another $5,000 for closing costs and holding costs. Now, holding costs are going to involve costs like your mortgage payment if you have a loan on the property, also any utility bills like water, sewer, trash, and power, and any other miscellaneous charges that are going to arise during the acquisition and the renovation stage for this example. Now your new total out-of-pocket cost is going to be $80,000. However, after you complete all renovations on the property, let's say that you go back to the bank to get the home reappraised for its new value after the renovations. And let's say that the new appraised value for this home is $120,000. Now there's a little known secret called a cash out refinance, and a cash out refinance allows you to take out up to 80% of your new home's appraised value. So $120,000 times 80% equals $96,000. Now $96,000 is going to be the new loan on this newly appraised property or this newly renovated property. So let's just say that you took that $96,000 and you paid off all previous loans. So maybe you had an acquisition loan, a renovation loan, or any other lines of credit that you open in order to help you bring this home up to value. So that $96,000 new loan pays off your previous out-of-pocket costs, which totaled $80,000, which leaves you with a remainder of $16,000. That $16,000 will go into your pocket tax-free, and let's just say that you put the home up for lease and you're able to receive a net profit of $300 every single month from this individual property. $300 in profit every single month times 12 months equals $3,600 in net profit on an annual basis, leaving you with an infinite cash-on-cash return on investment. Why? Because $3,600 divided by 0, which is going to be your out-of-pocket cost, equals an infinite cash-on-cash return on investment. Think of it this way. If I gave you a car with $16,000 in the trunk of that car for you to keep, and you decided to use that car and rent it out on Turo, which gave you $300 in profit every single month, what would be your total out-of-pocket cash investment? 0. What would be your monthly net profit every single month on that asset? $300. Since there is no monetary investment out of your pocket, but you're able to receive a profit every single month, that makes your cash on cash return on investment infinite. Now do me a favor, I'm always trying to improve the way that I communicate these different strategies, investments, terminologies, formulas, etc. So if this makes sense, do me a favor and let me know in the comment section below. If it doesn't make sense as well too, let me know in the comment section below. Just just so that next time I create a video, especially around real estate investing, I could really hammer home the cash on cash return on investment and how it works and how it's the only equation or formula that you should be focused on as a beginner real estate investor. Now, every step in the process is going to be significant and important. However, picking a market and narrowing down either a zip code or a neighborhood or even a block and your ability to calculate the numbers before submitting an offer will significantly increase your chances of finding a good deal. Now, let's move on to step number 3. Step number 3, find a deal. Now, after we've picked our strategy and picked our market, step number 3 is to find a deal. This step is where you learn to sharpen your axe as a real estate investor and a deal finder. Money is made during the research phase before you purchase a property because your buying decision is going to be made off of the projected numbers. Now, by far, this is one of my favorite steps, and as opposed to telling you what to do, I'm actually going to show you how to find a good deal and how to find a property to purchase right now. So in order to find a good deal, we need to know the projected income of a given area. And we need to be able to subtract our monthly debt, principal, interest, taxes, insurance, and property management fees from the projected income because that difference is going to be our profit. Now, it's also common practice to subtract the vacancy rate as well as the projected repairs over a given time frame. However, I don't like to do that because I always factor in 6 to 12 months worth of reserves, which acts as a piggy bank just in case if repairs need to be made in the future or if there is vacancy within an individual property. So just know, for the sake of this video and my calculations, I will not be adding in a vacancy rate or repair costs. Those will be factored into my reserves, which again, I like to leave 6 to 12 months worth of reserves in a separate piggy bank for those costs and for those expenses. Now, for this video and in order to find a deal, I'm going to be looking in the Akron, Ohio area under $100,000. Now, again, in order to find a deal, we need to know what the projected rental income will be for a subject property. I personally like to invest into single family homes with 3 bedrooms, 1 bath, and about 1,000 square feet to 1,500 square feet. That's going to be my buying criteria. So in order to understand what the projected rental income for this specific city, we're going to go over to for rent, and then we're going to change the bed bath count from 3 bedrooms and up and 1 bedroom and up. And this is going to give us our rental income for any specific area. Now, when I was looking at the for sale properties, I noticed that this property just hit the market and that's going to be listed for around $90,000, and that's going to be in the North Hill neighborhood. So for this example, I'm going to be looking also in the North Hill neighborhood and see what the projected rental income is for a 3 bedroom, 1 bath. So right here, 3 bedroom, 1 bath is for rent for $1,374. Square footage is unknown, but it looks like the home has just been recently renovated. Right over here, you have another rental, 3 bedroom, 1 bath, 1,200 square feet. Listed for $1,200 per month. And if we could scroll down right here, we have another couple of properties, 3 bedroom, 1 bath, 1,000 square feet for $1,100 per month, and another 3 bedroom, 1.5 bath, almost 1,400 square feet for $1,100 as well too. So as I start to analyze these properties, again, I'm looking for a single family residence, 3 bedrooms, 1 bath or greater, and I'm looking for general market rent per month. So it looks like these properties are ranging anywhere from $1,100 per month all the way up to $1,300 per month. So for this specific area, my projected rental income is going to float around $1,200 per month. And that's what I'm going to be using and judging the rental income and subtracting my monthly debts from this number right here, which is going to be $1,200. All right, so now that I go back to for sale properties in the Akron, Ohio area, now I just get to analyze every single property. This property is listed for $90,000, 3 bedroom, 1 bath, and less than 1,000 square feet. And this property right here is going to be listed for $80,000, 3 bedroom, 1 bath, and that's going to be closer to 1,400 square feet. This one sounds like a good deal. Let's go ahead and look at the photos. Okay, so this one has a lot of potential and looks like it could be a pretty good purchase. So now let's go ahead and analyze the numbers. All right, so you can use any mortgage calculator that you want. For the sake of simplicity, I'm going to be using Redfin's mortgage calculator that's going to be at the bottom of this listing. So this is a really good opportunity to actually talk about financing or funding your first acquisition. Now, there are 2 different types of loans that you could go after as a new real estate investor. The first is going to be a conventional loan, and the second is going to be a DSCR loan. Now, let's first talk about the conventional loan. Conventional loans on an investment property, minimum down is going to be 20%. Minimum FICO score score is going to be floating around 680, and your minimum loan amount is going to be roughly around $30,000 to $50,000. Now, at the time of purchase, the home needs to be in livable standard, meaning for conventional loans, they're not going to approve and qualify you for a loan if the house needs a lot of repairs. So during the appraisal and inspection process, the bank is going to analyze the property and make sure that it is structurally sound and that there's no major renovations that are needed on the property. So that's going to be key when it comes to qualifying for a conventional loan. Conventional loans are going to be full doc loans, meaning you're going to need to supply income documentations in the form of W-2s, 1099s, and tax returns, and your income is going to be judged in order to qualify for this loan to show your ability to repay. However, on a DSCR loan, minimum down payment is roughly going to be around 20%, same FICO score requirements, which is around 680, and the minimum loan amount on most DSCR loans is going to be floating around $75,000 to $100,000. So for this property right here, it might not qualify for a DSCR loan because the starting purchase price is going to be $80,000, and if we subtract the down payment of 20%, which is roughly around $16,000, that is leaving us with a loan amount of $64,000. However, DSCR loans are going to be great loans to get into investment properties or refinance after you renovate the property and bring up its appraised value. But DSCR loans are going to be great for real estate investors because you do not need to supply income documentation in the form of W-2, pay stubs, 1099s, and even tax returns. And as compared to conventional loans, which has a standard 21-day underwriting process from offer to close, DSCR loans have a shorter close process, anywhere from 10 to 15 days. On a DSCR loan, you could close pretty quickly on a property depending on how fast you could get the home appraised. But those are two different loan programs that you could use and utilize when investing into real property. Now back to analyzing this deal and analyzing the numbers. Now again, for this property, the list price is going to be $80,000. Down payment is going to be 20%. Let's just say if we're going to be using a conventional loan on this property, your loan term is going to be 30 years and it is going to be fixed for the duration of that 30 years, and your interest rate is going to be floating around 7%. Now to calculate your property taxes and homeowners insurance, Redfin has a formula or a percentage already baked into its native calculator. However, if you wanted to get granular, if you want to get very specific, what you could do is you could Google search Akron County or Akron, Ohio property tax rate, and that should give you a rough number of what the property tax rate is for that specific city in that specific state. So 1.69 is going to be our property tax rate. Let's go back into our mortgage calculator and plug in those numbers. 1.69%. Homeowners insurance on a $100,000 property is going to be roughly around $80 per month. After purchasing a handful of properties, I know this number like the back of my hand, so this is going to be very accurate to what your homeowners insurance bill will be every single month. Now, since this is a single family home, there are going to be no HOA fees. However, I like to plug in the property management fee in here in this calculator just to give me a rough number of what my total monthly debts are going to be. So the property management fee is going to be roughly around 10% of the monthly rental income. So the monthly rental income is going to be projected at $1,200. 10% of $1,200 is going to be $120. So now I have my total debt, which is going to include my principal, interest, taxes, and insurance, plus property management fees of $120 per month. And that's going to leave me with $738 per month as my total debt on a monthly basis. Now, $1,200 minus $738 is going to be $462 per month in net profit or net projected profit every single month if I were to acquire this property right here for $80,000 with 20% down. Let's look at another property and do the same calculations. Here's another beauty that I found right here, $85,000, 4-bedroom, 1-bath, around 1,200 to 1,300 square feet. And this is going to be in the Rolling Acres neighborhood. So let's go ahead and check what the projected rental income is for a 4-bedroom, 1-bath in this neighborhood. Okay, Rolling Acres over here, 4 bedrooms. Let's go ahead and change the bedroom count. Okay, 4 bedrooms in the Rolling Acres area is, all right, so after analyzing the data in this area, we're probably going to get roughly around $1,500 for a 4-bedroom, 1-bath. So let's plug the numbers into this property right here with a projected rental income of $1,500 per month. 20% down, which is going to be $17,000. $85,000 is going to be the purchase price. Term is going to be 30 years at a fixed rate of 7%. We know that the property tax rate is 1.69 for this area, leaving us with a property tax bill of $1,400 per month. Homeowners insurance, $85 per month. I'll go and leave that the same. Our projected monthly income is going to be $1,500 per month. So that's going to leave us with our property management fee of $150 each month, which is going to bring our total to $807 per month for principal, interest, taxes, insurance, and property management fees. Our projected monthly income for this property is going to be $1,500 per month minus $807, leaves us with a net profit of $693 per month, which is not too bad at all. $693 per month, times that by 12, our projected annual net income is going to be $8,316. And let's just say that we purchased this property with $17,000 down, with another $15,000 in renovation, which brings our total up to roughly around $32,000. If my math serves me correctly, let's go ahead and add in another $5,000 for closing costs and holding costs. So that's going to bring up our total from $32,000 all the way up to $37,000. Again, for this example, our net projected annual income is going to be $8,316. We divide that by $37,000. Gives us a number of 22%, which is going to be our projected cash on cash return on investment. So that's roughly how you analyze deals and roughly how you find a deal using the MLS and using basic numbers and basic calculations to formulate what your projected monthly income is, what your projected annual income will be, and what the projected cash on cash return on investment will be as well too. All right, so after we feel a little bit more confident with finding a deal, analyzing the numbers, now it's time to move on to step number 4. Step number 4, assemble a team or assemble an A team. However you want to say it, step number 4 is assembling a team. Now within that team, you're going to have a buyer's agent, a lender or loan officer, a great contractor, great and reliable property management company, and possibly even an attorney or an escrow office. This is going to be your A team, and these men and women are going to help you find and fund your first profitable positive cash flowing property. Now conventional advice is to find a good buyer's agent and use any and all recommendations from that buyer's agent to assemble your team. Now that's a very smart way to build a list of professionals that could potentially make up your A team. However, only relying on one individual, one professional, and one agent to build your team is not going to be the best idea. It's very important that you as a real estate investor know every individual's role when it comes to building your team and executing on finding a really good, profitable, and cash flowing property. Only relying on one individual's recommendations to build your team will significantly handicap you in your investing journey. Example, if your real estate agent recommends a loan officer that only specializes in conventional loans, which again are going to be full doc loans, but you're a self-employed individual and you write off the majority of your revenue on an annual basis on your tax returns, leaving you with very little taxable income, unfortunately, you will not get qualified for a conventional loan, which means that you will not be able to fund the acquisition. And if that's you and you're stuck in a binding contract because your agent recommended that you release all of your contingencies, well, now you're stuck in a bind. And it's scenarios just like this that cause real estate investors, 90% of real estate investors to be exact, to lose money on an investment. So I highly recommend that you learn as much as possible within every step or aspect in real estate investing so that you could be the leader of your team and not depend on any one professional to find a good deal and close on a property. Same thing goes for a contractor. Let's just say if a real estate agent recommends a good contractor who does great work, but they're priced 20% higher than the competition, and since they do great work, it takes them twice as long to get the job done. Choosing this recommended contractor will not only eat into your profit margins, but it will also open up the property to vandalism and theft because it's taking the contractor twice as long to get the job done. So just know that finding a good team or assembling a good team is going to take patience, trial and error, and a desire to not give up. You could get lucky and assemble a great team on your first purchase and then use that team to purchase your second, third, fourth, and fifth property, or you might have to kiss a couple of frogs to find good members of your team in the process. Nonetheless, it is going to be worth it in the end, because finding and assembling the right team is not only going to help you make thousands of dollars every single month, but it's also going to help you save thousands of dollars over your investing career. Now, there's so much more to go over when it comes to assembling a team, like which questions to ask or how to properly vet a team member and what are the costs associated with each profession. But for the sake of keeping this video as short as possible, we're going to move on to the next step. However, if you want me to talk more about how to assemble the right team for your real estate investing journey, do me a favor and comment the word team in the comment section below, and I'll create a separate video that pertains to assembling the right team for your real estate investing journey. Step number 5, start submitting offers. Now, the very first step in step number 5 is reviewing the purchase contract in the state that you're looking to invest in. Your buyer's agent will most likely not review this purchase contract with you, but it's very important that you do review it and you understand fully the terms and conditions in that contract. Purchase contracts within a given state are pretty standard, so northern counties and southern counties should have the same terms and conditions within a purchase contract. However, they are not standard from state to state. So if you are purchasing a property in a new state that you are doing business in, it is very important that you understand that purchase contract and its terms and conditions before you start submitting offers. Now, all purchase contracts should have the buyer's name, seller's name, the agent representing the buyer, agent representing the seller, the escrow office or attorney's office who will be handling all the funds during the transaction, the pricing that's associated with the property, terms and conditions, and a whole bunch of other mumbo jumbo. Now, it's very important that you understand all of the mumbo jumbo that's within a purchase contract, so please request a blank contract from your buyer's agent so that you could review before you start submitting offers. And if your buyer's agent is unwilling to give you or send you a blank copy of the purchase contract, then that's not the agent that you want to work with. Because if an agent is unwilling to send you a blank copy of a contract, then they are hiding something. What are they hiding? I don't know, but sending you a blank purchase contract shouldn't take no more than 5 minutes of their time. So ask for it early on in the process, especially before you start submitting offers. By the way, these purchase contracts exist to protect both the buyer and seller in a transaction and to make it as clear as day on the intentions of the buyer and seller when purchasing a property. Now, there are 3 major things that you should know and fully understand in a purchase contract, and those are going to be the contingencies, also known as a get out of jail free card. What do I mean by this? A contingency in a purchase contract will allow you to back out of the transaction or back out of the deal if you notice something seriously wrong when purchasing a piece of property. And I'll give you a couple of examples very soon after I lay out what contingencies are included in the purchase contract. Contingency number 1 is going to be your appraisal contingency. Number 2 is going to be your loan contingency, and number 3 is going to be your inspection contingency. And each contingency has a set number of days. Example, inspection contingency is roughly around 7 days, appraisal contingency is roughly around 10 days, and your loan contingency is also roughly around 10 days. And it will end on the 10th or 7th day depending on which contingency that we're talking about. Now, these contingencies are not added up, so if you have 10 days for a loan, 10 days for appraisal, and 7 days for your inspection, that doesn't mean that you have 27 days to do your due diligence. That just simply means that you have 10 days to either remove your contingency or cancel the contract. Now, if you remove all of your contingencies within a purchase contract and the home doesn't get appraised for the value that you want, or you cannot get a loan on the property, or maybe the roof needs an additional $15,000 worth of work, unfortunately, you cannot back out of the contract. So in this situation, you're in a bad spot, and unfortunately, you will have to move forward with purchasing the property or run the risk of losing your deposit. Now, I would normally recommend that you leave at least one contingency in when purchasing a property. However, since this is a beginner real estate investing guide, it's best to leave all 3 contingencies into your purchase contract and let the market decide if you should be more aggressive and release either 1, 2, or all of your contingencies to make your offer stand out. But please do not remove all of your contingencies unless you know exactly what you're doing and you know that home is going to be a home run. Now, as you start submitting offers, especially if you are submitting offers below asking price, you're going to come to the conclusion that the majority of your offers are either going to be countered or flat out rejected. Please don't get get discouraged because I found that in my investing journey, for every 10 properties that I submit offers on, at least one of them gets accepted. So oftentimes, if I'm looking to purchase 1 or 2 properties, I have to submit at least 20 offers. Also, as a beginner, you're going to have the urge to get into your very first deal, so you're going to be analyzing properties and say, F it, let's go ahead and submit offers on this property because I think it pencils out. Don't listen to that inner voice telling you to pull the trigger and buy that property. Listen to logic and listen to the numbers on your spreadsheet to determine if it's a good deal or not. Because numbers don't lie, but our emotion does. So check your emotion at the door and lead with logic and the numbers on your spreadsheet when it comes to real estate investing, because I promise you, you will thank yourself in the future because of it. Now, once you found a property and the seller has accepted your offer, now it's time to move on to step number 6. Step number 6, inspection and bids. Inspecting a property is non-negotiable. We're not buying homes at auctions, we're buying homes that need a little TLC that another family could call home. And during this step, you'll also be getting a contractor bid or multiple contractor bids depending on if you found a good contractor or not. Again, inspections and contractor bids are non-negotiable because we don't buy houses blind. It's not a good idea. Many sellers and agents intentionally leave out key information and photos on a listing to deceive inexperienced investors like yourself. Cracked foundations, half-burnt houses, and flooded basements are not uncommon findings during the inspection process. So do your due diligence right and don't skip this step. Now be mindful that as a beginner, it's best to find move-in ready homes or turnkey homes or homes that need minor to light renovations, as opposed to finding a house that costs less but needs major renovations. And another pro tip is to find a house that someone is currently living in and has decided to move out for whatever reason. Because finding a home that someone is currently living in gives you confirmation that the water, sewer, and electrical all work in the property. Because if you could avoid any electrical, plumbing, sewer, or structural problems or renovations, then you should do so at all costs. Because the cost of any one of these repairs could run you into the tens of thousands of dollars. Now in this step, it is important to know that every house comes with its problems. On an inspection report, it is not uncommon to get a list of things that need to be repaired. However, if you could give this list to your contractor so that they could include it into their estimate bid or total cost to renovate, then all you have to do is plug that number or the estimated cost to repair the house or renovate the house into your spreadsheet and into your cash on cash return on investment formula and let the numbers do the talking. Remember, 0 to 7% is considered a good cash on cash return on investment, 8 to 20% is considered a great cash on cash return on investment, and 20% or higher is considered pro status. Once you're done and everything looks good and you have a general understanding of the total out-of-pocket costs, now it's time to move on to step number 7. Step number 7 is to review your closing disclosures and close on the property. Depending on the state that you're looking to invest in, you could have upwards to 20 different disclosures that you need to review and sign. And unfortunately, your closing attorney or your buyer's agent will just simply send you all of these documents in one large lump sum of documents and expect you to review and sign on your own. Now, all of your disclosures are important and should be reviewed thoroughly before signing. However, there are 2 separate documents that I want you to take special note of before closing on a property. Number 1, the closing settlement statement, and number 2, title insurance. First, the closing settlement statement is going to have all of the debits and credits within a transaction and who pays for what. On this document, you're going to find charges like down payment, closing costs, who pays for the agent fees, and any seller or lender credits. Take your time reviewing these documents, and if you don't know what something is, ask your buyer's agent, the escrow officer, or the attorney who is handling the transaction to explain what those costs are and why you're being charged or not charged for something. If you're feeling overwhelmed and you don't know what you're looking at and you don't know what any of this means, it's probably a good idea to hire a coach. Now, I know coaches can cost a lot of money. I have personally seen and have been pitched myself $50,000 for a coach to hold my hand throughout the process. However, getting a real estate coach is not a bad idea. I would probably find somebody cheaper than $50,000 because $50,000, as you could see in the example of this video, you could probably find a house or a good deal to purchase and make all of the mistakes you want and let life and experience be your teacher or your coach. But if you could find somebody for $1,000, $2,500, or even $5,000, I think that's a great deal and great assurance to make sure that you find a profitable home that you could add to your rental portfolio. But feel free and pay whatever price you are comfortable with paying. Just know that any mistakes made throughout this entire process are going to fall on your shoulders. Investing into real estate is a simple business. However, there are sharks in the water. Matter of fact, there are a lot of sharks in the water. So buyer beware, or else you will pay for it. The second document to keep an eye out for and needs to be reviewed is going to be title insurance. This is a very important document that insures you against any liens, judgments, or any other complications found on title. Title insurance is so important because if you have dirty title, any liens or judgments on title, and you purchase a property, unfortunately, you will also inherit the liens and judgments along with the property. Example, let's just say that a seller of a home has a construction lien of $25,000 on that property that they did not pay, and you decided to buy that house without obtaining title insurance. If you buy that house, all liens will pass on to the new homeowner, which is going to be you. So unfortunately, you are going to inherit the property as well as the $25,000 construction lien that will need to be paid, or else that contractor will have no choice but to foreclose on the property in order to recoup what is owed to them. Title insurance is important for this reason and many more. So make sure that you get title insurance and obtain a copy of that title insurance and review it before you close on a property. Now, if title is clean and you have title insurance and everything pencils out on your settlement closing statement, now it's time to wire in your funds to the attorney or escrow office and close on the property. Be mindful that the closing process requires wet signatures on your behalf, so have an idea in mind on where you want to go and get your documents notarized. And once notarized, send in your documents to the attorney's office or closing office early so that you could close on time, and coordinate with your property management company so that you could go pick up the keys. Step number 8, renovate and market the property. If you already assembled your team prior to closing, then you should already have a contractor lined up to start renovations as soon as you get the keys. This should help you save a tremendous amount of time since you are ready on day one to start renovations. If you purchased a home that needs minor to light renovations or rehab, then your home should be ready to market within the first 30 days of acquisition. Again, I highly suggest that you find properties that need light to minor rehab or renovations so that you can list the property as quickly as possible and minimize the expenses that's associated with a vacant property. Now, once the renovations are done, now it's time to bring back in your property manager and take professional photos of the property and list it for rent on the internet. Common places to list a property for rent are going to be the local MLS, Redfin, Zillow, Trulia.com, and also affordablehousing.com as well too. Once your home is marketed for rent, your property manager will be responsible for all tours and accepting all applications from all potential tenants. And if you have a good property manager, then they will also vet all of the best applicants from all the applications submitted, share their findings with you, and allow you to make the final decision on which tenant to move forward with. And once you have found the best tenant, now it's time to move on to step number 9. Step number 9, prepare for occupancy. Now, this should be a very quick process, especially if your home is desired, 3 bedrooms, 1 bath, something suitable for families in a desirable location and neighborhood. Now, if you decided to go the Section 8 route, then you would need to prepare for the housing authority to send in their inspector to inspect the property to make sure that it's up to code, livable, and sanitary for the new tenant to move in and occupy the house. Once you pass inspection, then expect the tenant to move in very shortly thereafter. And if you decided to go the cash tenant route, then you will need to coordinate with your property management company to take the tenant through a final walkthrough of the property before they hand over the deposit and receive the keys. Now it's time to celebrate your first successful investment. Congratulations. Now, once you're done celebrating, report back to work because the next step is to open up your spreadsheet and prepare for accounting. Step number 10, keep solid books. It is very important that you keep solid books from day number 1. Accounting for all of your expenses will help you reduce your taxable income when it comes time for you to file taxes. The tax benefits for real estate investors are fantastic. Matter of fact, here is a screenshot of tax form Schedule E so that you could get a general understanding of what you could write off on your taxes. From advertising expenses to auto and travel, cleaning and maintenance, commissions, insurance, legal, management fees, mortgage interest, other interests, repairs, supplies, property taxes, utilities, and even depreciation. These are all the expenses that can be written off and should be written off in order to reduce your passive taxable income. Now you may be wondering, what is depreciation and how does it work? According to the IRS, you can depreciate a rental property if you meet all of these requirements. Number one, you own the property. Number two, you use the property in your business or as an income producing activity. Number three, the property has a determinable useful life, meaning it wears out, decays, gets used up, becomes obsolete, or loses its value from natural causes. Number four, the property is expected to last more than 1 year. Depreciation can be summed up in one simple equation. Property value times 70% divided by 27.5 years. Example, a property valued at $450,000 times 70% divided by 27.5 equals $11,454. This is how much it can potentially claim in depreciation on an annual basis, which will act as a phantom expense that reduces your taxable income. The reason why it's a phantom expense is because structures on real property don't just simply vanish or perish after 27.5 years. If the structure is still sound and standing, there is no reason to replace any parts or components of that structure. Now please don't take this information and become a slumlord. A slumlord is defined as a real estate investor who buys property and does the bare minimum to maintain the livability of a property. Minimal repairs, no upkeep, and only cares about profit. Our job as real estate investors is to provide structurally safe, livable homes for a tenant in exchange for profit, and make any repairs necessary to provide a safe and sound home. So keep solid books, account for all expenses, and legally write off everything. In conclusion, this is just a summarized video of all that is required from you as a real estate investor. So please do your due diligence and gather as much information as possible before you start submitting offers. Now, there is so much more that goes into buying your first rental property. However, please use this video as a guide and drop any questions that you have in the comment section below. I apologize for the long video, but the last thing I would want for you is to become one of the 90% of real estate investors who lose money on an investment. So thank you so much for watching this video. And if you want to learn more about what it takes in order to become a successful real estate investor and buy your first rental property, I have a few links for you in the description box below. And if you're looking for some of the best loans for real estate investors, watch this video right here. Thanks again for watching this video to the very end, and I'll catch you on the next one. Goodbye for now.